Good morning. Sound check, everybody. I am talking because it's 9 o'clock on the East Coast, which is the only time that matters if you trade the market. If you trade the U.S. stock market, that is. Morning, everybody. No, John, I have pre-programmed the seminar to shut down at 45 minutes, even if you're in the middle of a question, if I'm in the middle of an answer. So we should have plenty of time. What I'm going to do, and good morning, everybody. I'm going to start with questions. I did throw together this morning a dozen slides talking about a topic that is called longevity of long-term trades because I think it's a big issue. Not many people ask me about it, which kind of surprises me because when you think long-term, you think about building an account and holding it for years, and that's not what I've been doing the last 3 years. So I want to talk about that. Great, Gary. Let me take. Well, first of all, before you ask any questions, let me say that today's event is the exception where I typically don't have a topic chosen. So do questions first, but then I do have a topic, longevity of long-term trades. And does anybody have any questions? Gary, do you have a question? Here we go. Good morning, Paul. I came prepared with 2 questions for you, one of which may be, the first trivial one, in your weekly market review email, and as always a bull bear cartoon in the years that I have been getting these, I don't think I've ever seen a report and the offering label of the card. Well, Gary, for those of you that are very, very insightful, I actually spend more time picking out that cartoon, so I appreciate you asking about it, than I probably do writing the letter, because yes, I do try and pick a cartoon that is demonstrative of the current market environment, and some of them I think are rather funny. Like when I think we're at the end of the bull market, I had a lot of the bears sneaking up behind the bull with a rubber mallet or something like that. So I don't know if I can tell you where I get them or not. All right, I'm going to tell you because it's Saturday morning. I'm in a good mood. I'm going to tell you where I get them from, Gary. I have this thing on my computer called the internet, and I go to Google and I say cartoon bulls beating the bears stock market or something like that. And there are I always, of course, somebody does these cartoons. I leave their name on there. I don't imagine they would care because I leave their name on there. There's 2 or 3 cartoonists that do a lot of these. Like my favorite ones, I forgot the guy's name, but it's Ray's signature right on there. So if you Google them, you'll find that there are plenty of little cartoons like that. But yes, there's a lot of them. I pick a lot of time picking out the correct one. Assuming the proper context large times is in place, do you have a personal favorite setup or strategy will always catch your eye when trading during the day? Okay, so do you have yeah, so intraday trades, okay. Well, just to be clear, your setup is not an iron condor. That's a way to trade your setup. Obviously, you could do it a lot of different ways, but you like, after climactic moves, to do a neutral type move. Okay. My favorite things, I would have to, let me give you the seminar name for it, not to show off, but for those of you that follow me could understand it better. I think my favorite thing, based on the number of trades I do in this area, would be the mini DTS breakdown or breakouts using transition ABC, depending upon how far the mini gap is gone, and what we call in the room sometimes a drop and pop or that type of thing. Those turn out to be my favorites because they're what I call very precise type of trades. And for those, for the layman person who has no idea what that means, it would basically be something like this, that you have some kind of a trade from the prior day intraday closes like this or something. And you get a very small gap down. I'm not talking about a gap trade. I'm talking about this very small gap. And it maybe clears or comes close to clearing that, and you try to rally and fail. So, that's it. Obviously, picking that chart, I look at hundreds and hundreds and hundreds to find one. So it's not like that's an easy thing to find. But when that sets up, that's probably my favorite. So there's the answer to your 2 questions. And thank you for those 2 questions. Yeah, Hedgeye, that's the guy. Right, Eric, yeah. Now that you said the name, I recognize it, Hedgeye, yeah. Why the long-term view is bearish at 10, it has not unwinded the past 14 years. Yes, no. I'm going to actually, when I talk about longevity, I have a chart of the market, Tony, so maybe we talk about it better then. But no, we are not set to move higher in the long term. That naturally is my view. You can have your own view. Do you know if there is a precedent to the technical analysis? Jay, goes back like 200 years, as you know. What any of us do is not revolutionary. It's taking stuff, building on it, creating your own scenarios to look at it and view it. So I think the answer is they just built from experience. So and actually that's a good question. That's really a great question. The proper way to make money is to do what they did, what I do. Now, what I have done, because I mean, what I'm trying to get into, I guess, Jay, is that I've done the same thing in a sense, right? When I first started to trade, the first 3 months, I went off to figure out for myself because, like probably everybody listening to me, I felt I was a smart guy. Can't be that hard. I'll do the research and figure it out, right? And some of you have heard this story, but I'll tell it because it's the appropriate time. So after about 3 months of just kind of breaking even, I was actually doing options. I think I was actually making a little money. But then a day came where I got in a lot of trouble. I was down a lot of money in the positions, and they were options that were going to expire a week from Friday, and this is on a Friday. And I was in a ton of trouble. And then that Friday, everything went my way, and the trades came back into being about break even. And I had these two impulses that every trader still has today. Thank God I'm break even, give me my money back. But then this thought came over me. I said, wait a minute, I was in these trades for a reason because I thought they were going lower. Why should I get out now? So I decided to take a look at the chart and determine, based on the chart, whether or not they were going low or not, because I was short these. The position was a short. And I looked at the chart, and I looked at it once, I looked at it twice, I looked at it in different time frames. I stood on my head and looked at it. I looked at it with the lights on, the lights off, and what did I determine? What did I realize when the pressure was on and I wasn't just, playing with myself about my knowledge of charts? Yeah, I had no idea what I was doing. I had no clue. And that Monday, I went and signed up for some training. I didn't ask for a discount. I didn't wait for a sale. I just went and paid because, that's just what I thought the right thing to do was. And what brings me around full circle of those stories because, what I learned back then was like an extremely small fraction of what I do today. Every one of you who are learning to trade and are becoming successful or are successful, you're all a product of several things. You're a product of anything you ever read. You're a product of anybody who's ever taught you. You're a product probably to 50% or more of you have a mentor. If anybody who trained with me, you're probably 50% me. But then you're also influenced by your past experiences and your own personal biases. So you become your own trader all the time. And I think, what I had to learn back then was extremely minimal. I mean, I don't think it makes up 10% of what I teach today in terms of what actually makes money. And I don't want to go too far down the road, but I mean, you've heard me talk before about the difference between learning from a big company and learning from somebody like me who enjoys teaching you, wants to make you successful, and has no other ulterior motive. And I don't mean to turn this into a sales thing, but when you sign up for a seminar thing with me, there's one price you pay, there's never another penny you'd ever pay. When you sign with a big company, it's always, here's all you need until you're done and you're not making money. Oh, then you need the gold class, then you need the platinum class, then you need the super mentorship, and it never ends and you never really learn. And that, of course, is, I think some of you all realize, and just a problem with that. So I think the correct thing is to continue to build and learn. And one of the things I teach, Jay, in my seminar program is that even individually you do that. You take your trades, and then there's a process you go through to always continue to learn and build on what you've done and what you know, so that you keep getting better. And in a sense, then if you do that and then teach people that, I mean, that what I think is the proper thing is. Because what would the alternative to that be? The alternative to that, Jay, would be the stuff that doesn't work, right? Software programs, that pretend to be a quick fix, and all the other crap you see out there, technical indicators, and obviously none of that stuff works. So wow, you didn't expect that answer probably, did you? But it was really a great question, I think. All right, I'm kind of scrolled up to the question. I know a lot of you typing this. Let me go down and I'll come back to this if you have some more questions. But Don, I wonder if you have an opinion on two conformational indices, indicates, one based upon price volatility, the other on ATR. Don, some of you won't agree with me on this. First one crap, second one crap. I mean, they're just worthless. I never use them. I never keep them on the screen. ATR has a purpose, average true range, great. But I don't care. I mean, a lot of the trades I'm taking, Don, I'm taking them because I feel they're going to have an exceptional move, number one. And number two, I can see the stupid range on the chart. I don't need another number to tell me, oh, here's the average true range. There's my chart. There's what I'm going for. Worthless. Never, ever had on the screen. I know a lot of people like VWAP. And here's my comment to you. And I've said this in 100 different presentations to thousands of people at this point. Show me VWAP works. Show me how you make money with VWAP. Other than having some garbage thing on your chart that is a confirming indicator, which you shouldn't have on your chart, it's nothing. I don't use them. I've seen them. I've tried them. I play with them. I had people show them to me. It's never been proven to me that you can make a single penny with it. So you keep price on your screen. You understand that technical analysis is the monitoring of the battle of the bulls and the bears based on price action across 4 different time frames. You find those moments in time, and that's what it's all about, period. Scrolling down, I'm way behind you guys. If you can type it, it'd be great. I've got a question. I do have been several days up, waited for short since Wednesday, finally a nice drop Friday morning. How do you play that? Avoid false moves, wait Wednesday, Thursday. Okay, I'm not pulling up a chart, but let me pull up the IWM and give you a quick answer. Right, okay, I'm not saying that that is what I would do, but I'm not sure what your controversy is. If you want to short, you have a wide range bar hourly and a consolidation. Reg, it's just that's a 101 tactic for anybody. Just use the consolidation from Friday. And I'm not saying I'd want to do that. I'm just saying if you want to short, how do you play it? Do you have a wide bar consolidation? Okay, Craig, my first ever trade 20 years ago with no education was a 10 loss. You're probably not alone on that one. Well, yeah, Don and Richard Wyckoff got them from, the basic stuff has been around. Look, guys, the basic technical concepts have been around for 200 years. As a matter of fact, I'm thinking about doing an email just showing off the internet definitions of some of the stuff. The problem is that if you look it up, Google it, and read and understand it, the definitions will never make you a penny. If you look up the definition of support, it'll lose you money. If you look up the definition of a trend, it's rather worthless. It won't tell you how to understand when a trend is ending, how you should play it, none of that stuff. So it's one thing to say, it's kind of like saying, I want to learn how to sculpt a statue out of marble. And you read it, and there's a worded definition of how to do it. Okay, I'm sure the wording is right in a sense, but you're never going to sculpt a statue doing that, right? How do you catch a short from Friday morning? You don't, Reg, you can't. I wouldn't have been trying. Here's another thing, guys, what Reg is saying, is that you can't look at a chart and say, how could I have done that? I mean, you look for setups that you understand. And this is, again, a reason why I personally prefer stocks as my bread and butter over futures or Forex, because if you look at a stock chart and you don't understand it, you go to the next stock chart and you wait till you find something that you do understand that has high odds and a good chance of making money. So Reg is saying, how would I have done that? Well, I wouldn't have done that. And that's the problem. If that was a Forex pair or a futures trade and you had to make a decision, you make a bad decision. It's not something you can do, Reg. You can't look at a big red bar and go back and say, oh, how could I have captured that? Stuff happens all the time. You're not supposed to catch it all, right? All right, all right, we have a pause in questions. Let me go through, I have 10 minutes worth of slides here. And then we'll go back to some questions. And then, unless you have a question right now, I'm here for questions first. I just have filler slides. Thanks for bringing those questions. That was great. Here, Andres, given the high short-term interest rates in your search for exceptional incentives, doesn't it make sense in this current environment to have your cash invested in treasuries and buy options for the entry setup? It could make the net stop loss smaller. Having money in cash, again, there's two topics here. First of all, there is your financial planning, right? There is, and that's something I don't do with you guys. You know, how much money should you have in the market versus in stocks or in bonds, in real estate and whatever. What I'm here is for whatever money you want to put into the market. That's what I'm here to have you make money with that. But yes, it makes sense to be more cash. I've been very laid back in my long term for the last 3, 4 months. And I'll show you that in a minute and explain why. So that does make sense. I don't agree with the second one though. Buying options for entry. I mean, buying options, like you mean buying calls, Andres, at the money or out of the money calls as an alternative to buying the stocks? Well, I totally disagree with going long calls or short puts to replicate long or short positions. That's a terrible thing to do. That's a loser's game, a sucker's game for the most part, because you have time value constantly working against you. Selling puts, selling calls, selling spreads, that is something you should do with options if you want to. But uh, I don't feel there's any need to do that. I mean, you can trade stocks still. I mean, there's 1,500 to 2,000 stocks you could trade in a longer term account. There's 300 to 1,000 stocks you can day trade. There's always setups every day that you can do that make sense. For the longer term, yes, right now you should have most of your money in treasuries or something and just filter it back into the market as we start to get into something that makes sense. And I'm actually going to go over that in just a minute, okay? I don't understand Reg's question at all. Today, two rolls, Magnificent Seven and the rest. Yeah, well, Tony brings up a good question, and that is something I have pointed out in the room for a long time, is that there's not been a lot of market correlation lately. In other words, when I look at the market in the morning, maybe it's gapping up, maybe it's gapping down a dollar, right? The QQQ or the SPY, just a small gap down. But when I look at a list of 300 stocks that I keep for day trading, 80% of them are gapping up. And that's because what's happened is that there are 7 stocks in the NASDAQ 100 that now their total weight has made up, I think, half the index or something. So if these stocks are, 2 or 3 of these stocks are moving in one direction, it shows the whole market is up, and it's not really. So the market has become not a good indication of all stocks. The S&P 500, the NASDAQ 100 become more an indication of just the top handful of stocks. They did just redistribute, or they're redistributing the NASDAQ 100 right now to help fix that a little bit. Okay. Let me run through this real quick. Wednesday, I'm doing a presentation, and I'm giving in. I'm just going to do one called just some great trades. Everybody likes to see trades, so just going to flaunt some great trades, nothing fancy. So be there Wednesday for that. You'll get your emails over the weekend for it, of course. All right, long-term holds. The concept I'm getting at today is how long should you be holding long-term positions? Now, obviously, I like to day trade. There's day trading holds. Those are just during the trading day. I occasionally will hold some of those day trades over. That's my version of swing trading. I don't think anybody should be swing trading from a daily chart if you work another job. I have a whole video about that on the free stuff page. I think this is an extremely difficult way to make money, the way that it is taught basically in most places. Brokers like you to do it because it keeps you busy. It's nearly impossible to make money swing trading off a daily chart unless you're with the market during the trading day. And then, so I like day trading and long-term investing, where you're holding for weeks, turn to months, and can turn to years. I haven't had anything turn into years in the last 3-4 years. I want to explain why and when that will happen again. And that's the purpose of these slides, the duration of long-term holds. Everyone dreams about buying the next Microsoft. This is a big topic to me. Microsoft, public offering, 1986, $21 a share. If you'd invested $1,000 at the IPO, you would have had 47 shares at $21 a share. After stock splits, you'd actually have 13,000 shares today, cost basis of 7 cents, and your $1,000 would be worth $3.2 million. That's what everybody wants, right? Find that next great thing. I hate to tell you though, this is not what we do. This is not realistic. Does anybody know the original Microsoft logo? Picture it in your head. How far back do you go? I didn't know it. I didn't have a clue. Didn't look familiar to me at all. Here's the original Microsoft logo. Bottom left side right there. Boom, there it is. That's what their original logo was when the stock came out. But this is not realistic. Let me explain a big difference here if I could. If you own Microsoft all the time, you think investing is easy, right? I know somebody that has this. I know somebody that's just had stocks at a place that manages money. He's not into the market at all. doesn't understand the market. He's for years and years and years and years. Um, and he has some old names in there. And to him, investing is easy. You just buy Microsoft and hold on to it for 20 years. Okay, great. But that's not really a just comment. Anybody anybody who owns Microsoft would say just buy Microsoft 20 years ago and you make money. But that's the posteriori conclusion. In other words, now that you have Microsoft, looking backwards, it's easy to say just buy Microsoft. But the problem is when Microsoft came out, for any Microsoft you might have picked, there are 99 stocks that went bankrupt for every Microsoft, right? And you could say, oh, wait a minute, people in the know, I read this article, Microsoft's going to change the world, blah, blah, blah. Yeah, but you know what? There's 99 companies that were going to change the world at the same time Microsoft was, and they all went bankrupt. So it's not that simple. If you want to go out and get the next Microsoft, you don't need me. That's not what we do. That's not what I do. That is just speculation, okay? That's something different. It's a speculation account. You're not trading a chart. You're not trading an existing thing. You're not trading anything that I would do. There's nothing wrong with doing that. If you have a separate account, you want to do some speculation. But buying Microsoft 20 years ago was speculation. Now, somewhere along the way, buying Microsoft was not speculation. But it's also probably the case that you should not have been holding it that entire time, if you know what you're doing. Now, somebody who just, if you're 20, 30 years old, when the market crashes, then you just start buying the market with all your money and just hang on to it for 30 years and don't worry about it if you don't want to learn the market. If you do learn the market, you will understand that there are times that you can get in and out and make a lot more money doing that. But trying to go after and speculate and get the next little company and hold it for 20 years is not what we do here. It's not technical analysis. A couple of months ago, somebody asked me about a new technology called fuel cell technology. You guys heard about this? It makes electricity out of water to power cars. You ever heard of this technology? Yeah. Boy, that sounds revolutionary. Can you imagine that? Just powering cars on water? Yeah, exactly. And I had to laugh at the guy. I'm like, you got to be kidding me. You want to buy fuel cell stocks because they're new technology? Wake up, buddy. They came out 20 years ago. Here's how you would have done if you had fuel cell. Fuel cell hit a high of, after reverse stock splits and all that, hit a high of $2,923 back in 2004 or something like that. And today it's worth $2.21. So there's another great technology that was a sure thing. And you know what? You can go look it up. There's dozens and dozens and dozens of these, right? These are speculative things. So this is not what it's about. If you want to speculate, go sign up at your favorite newsletter. Nobody's going to do better than anybody else. If you want a speculation newsletter, I'll tell you right now, pick any one you want. It doesn't matter. They're all the same. Pick any one you want. Everyone's going to get one right once in a while. The rest will all be losers. I don't care how much money they spend. I don't care how much research, whatever it is, because stuff changes. And some companies go broke. A few make it through, right? Water fuel in the 60s? You mean you just used to pour water into your friend's gasoline tank and see if it would work? So point being is that type of longevity, trying to get something out of its infancy, is not really trading. What we do is we wait for stocks to be successful and then we catch them. Now, obviously, Microsoft is a long-term hold. Many times could have been done over the years, and so could have a lot of other stocks. What we want to do is trade the stocks that make us money over time, not the names that we love or the names that somebody says are great. So I wanted to, not a great long-term hold, right? So longevity over the last few years. And so this is a monthly chart of the QQQ, and you can get a little vision here of what's going on. Here's 2020. And I started doing the long-term letter at the end of 2018. I started doing that. It was positive, but I barely did anything. 2019 was up very nicely. 2020 was up a little bit. But my point simply being was that when you're right here and you're looking at long-term trades, do you expect to have longevity, everybody? This is just a common sense question. You don't have to be a great technical analyst. Do you expect to have great longevity in the typical stock if you're buying it in 2021, 2022? Anybody? No. Why? Well, because we came from here to here. We came from here to here. We came from here to here, and now we're here, right? I don't expect that at all. So I'm going to show you I'm going to show you the average hold of some of my better trades over the last 3 years but it's not anything. Nothing hit a year even. Nothing came close to that because on the way up through here, I was very speculative of the market top coming in, and we got close to it. I declared we were at the top, and actually then I shorted through here. My long-term trades were short through here, declared a bottom there, went back to long through here, and then the mixture. I'll show you exactly here. I'm sorry, it's right here on the chart. I just did this morning. Forgive me. So A, you can see right here, A, B, C, D. A was a mixture, mostly a mix of short and long because we're getting to the top. And that's my thing, is that I like to do a mixture of shorts and longs. When we're getting toward a top, I like to have unique short, market long, and et cetera, et cetera. B, mostly short, almost entirely short during the drop. C, October of last year declared a bottom, so it got to a mix of long and shorts. And then D, mostly long. Now, what was really funny, and you'll see this in a minute, not funny, it's kind of sad, is that I had a tough time through here. I was long. I had a whole bunch of long stop up right through here. I'll show you that in a minute. So 2021, long-term trader, great year. 2022, I was doing better than that. Lost a little bit back at the end of the year, but still a great year. That of course, was the big market decline. So up big and a big market decline. Start off this year fantastic. Well, that's 1 month, first month of the year. It just had a great trade in there, so it just makes it look great as an annual number. More reasonable as we got into the third month of the year. And then from there, I gave it back. And I gave it back over the next 3 months, and I've been just flat for the last 3 months and not doing a whole lot. So how do I, with the right market bias, end up flat? Well, I'm going to tell you this, but don't ever repeat it to anybody. I may have to edit it out of the video. If I told you why, you would think I was a brand new trader. And the truth of it is, I have to put it on me. But boy, if I ever had a time where I felt I had bad luck, it was just unbelievable. These longs that I did at the beginning of this year, unbelievable. Intel, I went long Intel here. That next day, they said something stupid. They announced something. Boom. It went up 40%, and I didn't have that because I got shaken out of it. Boom. I shorted Monster just recently here. I shorted it right here. Look at this. Huge decline. Target number 1 was right there, and it shook me out the next day over. Now, I can say I have bad luck, but that's a stupid comment. This is on me. It's my fault. I should know, I should understand, I should have better adjusted my style of long-term trading, at least during this last 3-4 years, where we're in a jittery market where I knew we were near the top at one point, and then we had the drop, and then we have a rally that's not the start of a new bull market. So my average sharp rate, my sharp ratio for these 2 years was over 4. That's a 4 reward to risk average at the end of the year. That's huge. And that's because I take aggressive entries and hang on to stuff. The problem was these aggressive entries weren't working during a time where what happened to me 3 times in a row was I took a long, the Fed came on and said something, market tanked for that day and then came back the next day. And it's on me. I can say, oh, it is bad luck, but you know what? You have to understand that that's going to happen to you when you're trying to get too cute in a sloppy market. So I've been just really laid back the last 3 months. So just talk about longevity. Here's the longevity. I just want to show you the longevity has not been long over the last 2-3 years. That's going to change maybe a year from now. But I just want to show you, these were the nicer winners, the longer holds, and starting with most recently. The most recent nice winner I had just exited just the end of last month, a couple weeks ago, and that was W. It was only held for 6 weeks. It made 5 Rs total. The biggest target was a 9R target 3. You can see it right there. That's the R amount there. Before that was cost, and I got to go back to the beginning of the year, held 5 weeks only for a 6R trade. And that means 6 times what was risk. If you risk $1,000, you made $6,000 on the one trade. And that had a 10R target 2. Notice here, most of these, target 2 was the biggest target. I gave something back on target 3 by trailing it. Adobe, going back to the beginning of the year, held 5 weeks for a total of 6 Rs. Biggest target, just like cost, was a 9R target 2. I sometimes, Peter, but it's not the right entry now. I don't chase stuff. I don't chase stuff. So I got the right entry for that. So you don't get married to a stock market. So then Then going back to the prior year, just some of the highlights, going backwards in time. The end of the year, CNP was held for 6 weeks, 6-hour trade. Biggest target was the last one, 8.5 hours. Another 6 weeks for Adobe. Adobe was a 10-hour trade out the door, including a 13-hour last target. Rost, another 10-hour trade. But notice these are 6-week holds. All of these in 2022 were 6-week holds, and that's the longest hold so far. MU was a short that I had in the midst of 500 bullish analyst recommendations. And somebody wrote me about this because they messed it up because of that. Don't listen to the idiots on TV. I shorted MU in the middle of the time when they're giving money to all the semiconductor stocks. Why? Because the chart said to do that. 10-hour trade held 6 weeks. It's amazing everything is 6 weeks. And here target 3 was the biggest target. And then going back before that, Ford was held 6 weeks for 5 hours. The last target on Ford stopped out by 2 cents, and it went on to be, I think, I don't want to make up the number, I think it was the 35-hour trade or something like that. And I got out of it for a few cents. It just, it happens sometimes. IGT was the longest hold, I think, right? No, STZ was. ITG was 11 weeks for 14 hours. 7 weeks for 8 hours on WB, STZ, 25 weeks. That was the longest hold I had on something. And it wasn't even that big of a trade. It was just, just kept dribbling along. 25 weeks, so that's a 5-month hold was the biggest hold I had, and that was an exception. The rest were all under 2 months. AUPH, 10 hours and 4 weeks. That's because the last day it had a nice gap up in my favor. Did I do the right thing by exiting? In other words, longevity, Paul, you're not holding all that long. Well, yeah, it was the right thing. I made my money on Ford through here, and look where it is now. It went down to here, went down to here, down to here. Holding Ford would not have been helpful, and this is true for most everything that I did. I had reasonably good exits on things. Same thing with IGT. I had IGT, huge trade through here. Guess where it went down to? Now it's back to here, but if I loved IGT, why not exit up here like I did, and why not get back in when this downtrend ends? It could get back in here somewhere, right? Why didn't I get back into IGT? Well, because I'm not married to IGT. At that period in time, I found other stocks that I thought had better setups to get into. So I did get long. I just don't have to get long IGT. If you're only trading the market, you have to decide, do I get out? Do I get back in? From trading stocks, I can pick the best setup that I like. Now, eventually, let me give you a little real learning thing here. What I will be doing eventually when we're back to long-term bullish bias, what I eventually will do, I'm going to give you a little secret here, what I do that makes a lot of sense, is that if you have a long-term bullish bias, like, hey, here we go in the stock market for the next 10 years, what you do is you buy IGT and you sell the quick third. 10 hours, it's not exactly quick. And then you hold the rest of it. And you hold the second third until you can't stand it, and you hold the third forever. Because the problem is in long bull markets, people tend to have been out of all their longs way before the end of the bull market. So that back third becomes your long-term portfolio. It makes sense? And when you do it that way, you never get in trouble. You're never negative. You're holding the back third of big winners, and you continue to cycle in and out of stocks as you're allowed to based on how your first thirds are doing on the other stocks. One of the biggest tips I could ever give you in the secret to me to long-term investing, you never say, oh, here's the market bottom, let me put my whole account in here, and then you're wrong and you're down 20% in a month. You never do that. That's why people get in trouble. Here is a period of time that we will look forward to again in the future sometime. This is where you just keep building your portfolio, right? That was that great period of time. You guys, a lot of you didn't know me back then, but I after the 2008 crash, I had the low to the week. To the week. I had the low to the week. And I said we're going to be in a 10-year rally. It turned out to be more than 10 years, but that's okay. This is where you focus on just building that portfolio. A nice, tight, beautiful uptrend, okay? As we get into the next part of this, we start to accelerate, and the acceleration causes choppiness. Why does that happen? When you start to move up too quickly, people want to take profits, and when they're not allowed, and when you accelerate higher, when the profit taking comes, all these people have to unwind, you get these more violent moves. This is where you can start taking advantage. And I was very short through here. I made a lot of money shorting this right in here. I had it short to the day in that case. This one here, I shorted. I wasn't as accurate with it. I don't remember exactly how that happened. And this is where you start getting choppier. And this is where you start taking some of your, your super winners and start dumping some of them off. And then through here becomes this acceleration. And this is where you just don't know where the top is going to be. It could come any single time in here. This is an extremely long accelerated period after the rally we had. And this is where you start mixing it in. And what I started doing in here was throughout this last 9 months, I started mixing in longs and shorts. All of my shorts worked in here. In other words, even though I didn't get the market top, I should say I started shorting some stocks before the market top, but all of those shorts worked. And then naturally, as we turn the corner, it was all short through here. So you find the market top by rotating in unique stocks that are already showing their weakness. So that's how you trade this. Now, someday, what I'd like to look forward to, where we will talk about trades being held for over a year, is when we get back to this, which will happen when we're back down here somewhere. Okay? Boom. I think that's done. Your midterm view is bullish. Yes. Yes. My long, and just to be clear here, my midterm view went bullish in October, pretty perfectly. I stopped being bearish. I went bullish with not a lot of tradability to bullish with tradability throughout October, going into the end of the year. I flipped to bearish because we're at a moment in time. I've said, since even in the free newsletter I put out, I've said in October that I did not know where this top would be. As a matter of fact, I've said nobody on planet Earth can tell you where that top could be. I don't mean to sound cocky, but if I can't tell you, nobody can tell you. I can't tell you where that will be because this is like, go back and look at 2020, 2002, 2001, 2002. This is a replay of that. And so we came to a moment in time in here somewhere where I flipped the midterm bias to short for, I have it on the screen here. I had a little note to myself here. I flipped to bearish on May 10th, and then I flipped back on February 10th and flipped back to bearish on May 18th. So there was a 3-month period in there where I flipped to short midterm bias, went back to bullish for this whole last 4 months, whatever it is. So your question is, do you think we're a new high? I don't know, Andres. This could be a complete retest and failure where we do come here. I don't think it's, and by the way, it will not be relevant. The right scenario, what I'm looking for, Andres, is, and I'll tell you this because it's no secret, and it's not like the magic that'll make you money, but I want to see the market rally now on good news. In other words, I want to hear somebody say, okay, we're going to lower interest rates, which the market will perceive as good news. It is already built in the fact that they're not going to lower, that they're not going to raise interest rates anymore. So we'll get a celebratory rally, and maybe that even breaks that high, and that'll be the short of all times when that happens. And then you're going to see the real correction come at that point in time. So in between now and then, it's just very much a stock picker's market. I've been just laid back because of the, kind of getting knocked out of things. I've got it. The last trade was a good one. The W I just sold, and I have another long in place is doing okay. Don't you need a log scale? Well, Jay, what matters is that you, well, no, in my view, Jay, the log scale would simply give you the incorrect view of taming the acceleration. That's what it's there for, right? No, I want to see what it actually is. I mean, it's kind of like Jay, we're looking out the window at something, and I'm looking through glass, and you say, well, Paul, I don't think that's the right look. You should look through my telescope or whatever. I mean, you have the altered view. So, I mean, the bottom line is, Jay, you should look at the same thing all the time. So, Eric, you obviously agree with my analogy, correct? It's like I'm looking through a clear window saying, here's what's really there, and Jay wants to look through some warped glass to get a different look at it, right? Right, and what Eric said too, is really just how you trained, right? But just look at it mathematically, just run the numbers. Especially if you go back even further on the chart to, I didn't include this, but what is funny is, I should have gone a little further back, but it wasn't my point today. If you look at the debacle of 2008, you can't even see it on the chart, guys. Remember the tremendous crash of 2008? Well, it was like this. That's all it was. So there's your perception, Jay. is to look at that tremendous crash we had in 2008, and you don't even see it, but a blip on the chart today. That's what matters. What kind of price action do you expect to see to indicate correction is imminent? Well, Nicola, that would that answer involves a total understanding of everything about technical analysis. It could happen in several different ways. There's no one-line answer I could give you. Technical analysis is the monitoring of the battle between the bulls and the bears across the 4 time frames that matter to whatever time frame you're looking at. So I cannot project to you what exactly will happen. When it happens, I'll know it, but there's several different ways that it could happen. What we're at a deficit here is that every time we would get to an area, I knew we were in the area, and I could look for something to happen. The problem here is I don't know where the area is. So it's going to make the top more difficult to find over here. Are there any more questions? That's my last slide. Remember to be here Wednesday. Many already down 70. What, many stocks you mean, Tony? Oh, yeah, individual stocks, sure, of course. Sectors rotate, things go around, right? I want you to notice, guys, if you go back, if you take a look at these symbols, look at what I trade at the same time. Retail, tech, chips, energy, right? I don't care what it is, but you'll have that. You'll have individual stocks that totally collapse. What matters is, Tony, is the money flowing in or out of the market? And that's why we look at bigger indices to determine that. And when I look at that question, I also look at the small caps, the IWM. All right. See you on Wednesday, and go about your Saturday.